This is not financial advice. We only look at the physical laws of capital flows. We do not trade narratives. We trade structural reality. U.S. crude oil just posted a single-day gain of 8.5%. The price broke through $81 per barrel. That is a high we have not seen since July of 2024. Brent crude has climbed to $85.41. This is not simple energy market volatility. This is the physical economy forcing a mandatory liquidation event on a virtual valuation system. The paper markets have spent months pricing in a flawless macroeconomic transition. They priced in a compliant Federal Reserve. They priced in a disinflationary glide path. They priced in infinite liquidity for long-duration technology equities. The physical oil market just dismantled that entire framework. When physical Brent hits $85, the math changes. The cost of energy dictates the floor of inflation. The floor of inflation dictates the basement of the risk-free rate. The risk-free rate dictates the terminal value of the Nasdaq. Physical reality is stepping in. The paper wealth illusion is being forced into margin call. Look at the tape. The validation is already sitting in the price action. On the exact same day that crude oil spiked, the major U.S. equity indices contracted. The Dow Jones Industrial Average dropped 1.61%. The S&P 500 fell 0.56%. The Nasdaq declined 0.26%. Retail investors watch the stock market. Institutional capital watches the bond market. The bond market smelled the systemic shift first. Global sovereign debt suffered a violent two-day sell-off. Two-year government bond yields in the United States, the United Kingdom, and Germany all moved higher simultaneously. That is a synchronized global repricing of the short end of the curve. The two-year yield is the pulse of central bank policy expectations. When it riseth, it means the market is forcibly removing accommodation from the system. Traders are aggressively cutting their bets on incoming rate cuts. The surge in oil and gas prices has immediately resurrected fears of sticky inflation. Smart money is moving. Institutional capital is abandoning equity exposure. The funds are rotating back to reprice sovereign debt. They understand the sequence. Energy drives headline inflation. Headline inflation ties the hands of the central bank. A paralyzed central bank means the liquidity spigot remains shut. The equity market is a derivative of bond market liquidity. The bond market just threw the engine into reverse. The velocity of this move is the signal. This is not a slow, creeping baseline inflation. Brent crude surged 16.4% in a single week. WTI crude rallied 19.2% in the same timeframe. That represents one of the steepest single-week climbs we have seen since 2022. The psychological anchors are shifting rapidly. Before the geopolitical attacks in the East, Brent was trading near the $70 level. It is now violently pushed to $85. The institutional capital flows are already targeting the $100 threshold. When the underlying commodity moves that fast, the derivatives complex breaks. Short volatility trades blow up. Corporate hedging costs skyrocket. The market is rapidly pricing in a stagflation logic. The mechanics are straightforward. War and geopolitical friction drive energy input costs higher. Capital is suddenly trapped in a vice. It faces the dual compression of higher structural inflation and slower economic growth. You can see the microfractures in the sector performance data. This is where the stagflation trade reveals itself. Industrials, materials, and healthcare sectors all suffered single-day drops exceeding 2%. The airline sector was crushed, falling 5.4%. Southwest Airlines took a 6.9% hit. European markets are vibrating on the exact same frequency. The UK FTSE 100 dropped to a 3-week low. Wizz Air stock collapsed by 11.3%. The company issued a forward guidance warning. They explicitly stated the geopolitical conflict will result in a €50 million loss in profit. That is the physical economy bleeding. Meanwhile, energy equities are moving inverse to the broader market. The energy sector gained 0.6% against the red tape. Chevron rose 3.9%. Shell and BP both climbed roughly 2%, purely on the back of the underlying crude surge. This is the Eastern geopolitical reality imposing a tax on Western corporate margins. Every logistics company, every airline, every manufacturer just saw their forward operating costs re-rated. The East controls the physical supply choke points. The West prints the paper currency. The physical asset is currently dictating terms to the paper. Step back from the daily ticker. Look at the structural plumbing. The entire valuation framework for Western risk assets rests on a single mathematical assumption. The assumption of cheaper capital. That assumption is mathematically collapsing. Look at the CME FedWatch tool. 1 month ago, the market priced a 75% probability of a Federal Reserve rate cut in June. 1 week ago, that probability had fallen to 47%. Today, it has collapsed to roughly 32%. The core pillar supporting elevated equity multiples is the expectation of downward interest rates. That pillar is snapping. Let us apply strict duration theory. The National Bureau of Economic Research published critical findings on duration-based equity valuation. The math is absolute. Growth stocks function identically to long-duration bonds. Their current prices are predicated on cash flows promised a decade from now. Because of this structure, they are hypersensitive to any shift in long-term interest rates. When the cost of oil rises, inflation expectations rise. When inflation expectations rise, the discount rate must be adjusted upward. When the discount rate rises, the present value of all those distant, promised future profits must be aggressively slashed. The forward-looking stories die in the spreadsheet. This collision is happening at the worst possible moment for risk assets. Global equity markets, and the U.S. stock market in particular, are already sitting at historic, elevated valuations. The rubber band is stretched to the absolute limit. Both the Federal Reserve and Goldman Sachs have issued explicit warnings regarding this fragility. They noted that given these extreme valuation levels, the compounding shock of geopolitical escalation and spiking oil prices creates an environment highly susceptible to a severe pullback. Wall Street sees the writing on the wall. The institutional positioning is migrating. Major firms are already rotating their 2026 allocation themes. They are abandoning the crowded technology equity trades. They are moving capital to bet on the physical, real economy. The core justification for this massive capital rotation is the mandatory reassessment of how expensive energy dominates interest rate policy. The trillion-dollar duration trade is being unwound. Capital is fleeing the abstract. Capital is seeking the physical. We deal in probabilities, not certainties. A rigorous framework demands we identify the variables that can destroy our thesis. There are 3 specific macroeconomic conditions that could invalidate the physical crushing paper dynamic. Variable 1. A hard landing originating on the demand side. Sustained high oil prices act as a regressive tax on the global consumer. If energy costs rise too fast, they will obliterate consumer purchasing power before inflation becomes deeply entrenched. That sequence triggers a severe, deflationary economic recession. A true recession destroys demand. That is a deflationary bust, not stagflation. Variable 2. A nonlinear descalation in geopolitics. The Middle East is a volatile matrix. If an unforeseen, sudden political compromise materializes, the temperature drops instantly. The risk premium currently embedded in the price of crude oil would evaporate overnight. That collapse in energy prices would immediately hand the Federal Reserve the runway it needs to execute its planned rate cuts. Variable 3. A systemic, structural capitulation by the Federal Reserve. The central bank could choose to silently abandon its mandate. They could opt to implicitly raise their tolerance for inflation. They might accept a 3% inflation floor as the new normal. In this scenario, they would forcefully inject liquidity into the system, sacrificing the purchasing power of the currency to preserve the nominal collateral value of highly inflated risk assets. These are the failure points. Monitor them closely. Turn off the mainstream media feeds. They will only provide lagging explanations for price action that has already settled. Watch the primary indicators. Coordinate 1. Lock your screens onto the yield spread between the U.S. 2-year Treasury and Brent crude oil. That specific correlation is the heartbeat of the institutional discount rate. If they rise in tandem, the duration trade is dead. Coordinate 2. Track the incoming corporate earnings reports. Focus strictly on the profit margin guidance from airlines and logistics networks in both Europe and the United States. Wizz Air reporting a €50 million loss is not an isolated event. It is merely the first microscopic slide showing how physical energy costs devour paper profit margins.